Your market news now. In Asian equities, losses were seen across China and Hong Kong, while Japan's Nikkei, which had its best year for a decade in 2023, climbed 1% in early trade to break above 34,000 for the first time since 1990. Traders are awaiting U.S. inflation data that's due tomorrow to assess the timing and size of any Federal Reserve interest rate cuts in 2024. Expectations that Fed could start cutting rates as soon as March have been slowly decreasing. Markets are currently pricing in a nearly 68% chance that the Fed could begin easing rates in March. To talk to us a little bit more about the market dynamics, we are joined by Patrick Matidi, who is the head of equities at Aluwani Capital. Patrick, thank you so much for your time. With the second trading week of 2024 firmly kicked off, what's driving markets right now?
Yeah, good afternoon, Anastasia, and thanks for having me. Look, the inflation story remains top of mind for the markets. So I think it's fair to say we have seen the peak, and now inflation, that trend is on the downside. But as I said in your intro, the focus now remains the timing and the size of the cuts that are much anticipated. So we have seen a few data points coming through, especially on the labor side, which points to the labor market, especially in the U.S., still being fairly strong, which can scupper, the hopes of an earlier rate cut cycle. But then, as you mentioned, we are looking for the inflation numbers tomorrow to give us guidance that indeed inflation is firmly on the downside, which then will give us, the markets from a whole point of view, a further comfort and confidence that indeed, the expectations from March onwards for a cut are well intentions, from a market expectation point of view.
Speaking of those inflation numbers, as you mentioned, they are out tomorrow, but the following day, we've got the U.S. banks kicking us off for U.S. earnings season. Between U.S. CPI and U.S. earnings season, what's important here? Is it the corporate fundamental outlook, or is this the idea of it still being a macro economy?
I think the macros continue to trump and remain an area of focus. The earnings are great because they give you a sense of how the companies have done, but they are looking back, to the year that has been as the companies report. What's important for markets is the way forward. And so the macros become important, especially if, we continue to see the downward trend in inflation. That bodes well for growth, growth in a low inflation environment, as evidenced by lower interest rates. And then that ultimately comes back to corporate earnings, where companies can expect better earnings because the economy is growing, the consumer is in a better state given the rate cuts. But certainly the dynamic remains that of the outlook on inflation from a focus point of view.
Are there any lingering concerns for you for 2024? And also, how are you factoring them in your outlook, say, for the next 6 months?
Yeah, an interesting question. There's a lot to be concerned about. I think to start off with the geopolitical tensions that continue to linger, be it in the Middle East, be it in the Gulf in terms of the Red Sea. I think those have got the potential to can cause inflation, which then obviously can derail the expectations of inflation coming down and also interest rates coming down. So those are the risks that we are seeing that keep us awake, despite us being very constructive and positive on the pure fundamentals. So assuming everything goes well as expected, that's fine for the markets. But if we do get these geopolitical tensions coming through and all these other risks, I think we could have a different turn when it comes to the markets. And then closer to your home, I think the next 6 months will be key from an elections point of view. So it's not so much the elections that are coming through, but the outcome thereof, where we are likely to have a different regime going forward. That becomes important from markets point of view as we try to understand what does it mean from a policy continuity and certainty point of view, but also, who's in, who's out, and how they're going to work, especially if we end up with coalitions, which is what a lot of the analysts are saying in terms of the outcome for the elections in the next 6 months or so.
Where are you seeing opportunities in this market?
Certainly on the equity side, equities, if you look at last year and even the year before, have actually been underperforming. A lot of it is just pure sentiment, given some of the factors that have been at play. But if you just strip out the sentiment and look at fundamentals, the equity market is very, very cheap. It's offering a lot of value. But that value won't be realized until we have some certainty when it comes to issues like load shedding, a lot of policy certainty and also the elections coming out. But if you're willing to overlook some of those factors, certainly on the equity side, we think there's a lot of value as compared to, say, on the bond side that has run very hard. And also, cash has been king, but I think in a low inflation environment, cash will underperform. And if you want to be in equities, given that rates are going to come lower, and that means that, the consumer will be in a better position to can spend, and that means better corporate earnings, which is good for equity markets.
Your conviction for big tech in 2024, are you waiting for those dips or are you looking for the right time to get in?
In fact, we're looking slightly elsewhere. So 2023 was a good year for tech, especially in the US. The so-called Magnificent Seven did very, very well. But I would think, and that was driven largely by the whole AI drive, artificial intelligence. We think that has run its course in terms of the early adopters. So we're looking at the beneficiaries of artificial intelligence. So businesses in normal industries that are likely to can then use that AI technology to can better themselves in terms of how they operate, how they deliver to their clients. So we think there's a lot of opportunity that is not well priced in those secondary markets where those businesses are likely to be beneficiaries and therefore adopt, they develop the IT that has come through from some of the Magnificent Seven who have benefited last year. So for us, just looking at the value chain and say who's next. And for us, the early adopters have done well. That those are the guys who come with the technology. But we think the next phase will be those who can take the technology and actually create efficiencies for themselves and create value for shareholders.
Patrick, thank you so much for your time this afternoon. That is Patrick Matidi, who is the head of equities at Aluwane Capital, looking at the Rand currently at 18.62. And of course, we are watching that Brent crude price, 77.59. It's holding steady after giving up some gains, with the market trying to find a balance between those Middle East concerns as well as some of the weak economic growth outlooks in the Eurozone area. However, we're going to take a quick break. When we come back, we'll have more news for you, so stay tuned.